Hi everyone. I'm going to talk a bit about the main events related to property for the month of May. Now, it was really all about petrol prices. If we look at the manufacturing PMI, it's still above 50, so it doesn't seem as if the economy has slowed much yet, which I guess is some good news. But if we look at inflationary pressures, that's where the trouble starts to brew. Oil prices are high. We know it's a lot to do with Ukraine conflict and Russia sanctions, $120 a barrel Brent crude. So global oil prices have been a problem, along with general supply chain related inflationary pressures across the world. So interest rates have been rising. CPI inflation is at 5.9%. About a year ago it was nearer to 2%, and interest rates have started rising with it since late last year. Now, key events, early this month, petrol price inflation goes up about 41% year on year. That's after a 25% year on year inflation rate in petrol prices last month. So petrol prices still look like they're going to bring more inflationary pressure and more upward pressure on the CPI in the coming month or two. Interest rates went up by 50 basis points during May, at the May meeting of the MPC. They were going by 25 basis points up per meeting, and now it's accelerated to 50 basis points. So I think what that does to commercial property overall is it introduces a little bit of concern, a little bit more caution. I think the signal is that the SARB wants to deal effectively with inflation, that it's prepared to ratchet up the hiking if need be. And so I think what we might see after our FNB property broker survey for commercial property showing an increase in sales activity across all three major sectors, office, industrial and retail, during the early stages of this year. I think as we move into the second part of the year, we could just see that start to slow, because we are expecting further interest rate hiking to come. The FNB expectation is that whereas the prime rate is now 8.25%, it might end the year on 9.25%. So still some expected hikes to come, we believe. So that's the bigger picture of the economy. It's about inflationary pressures and rising interest rates and slowing buyer demand, we believe, in the commercial property sector. Let's have a look at some more specific impacts that I see happening as a result of the petrol price hike specifically. Hotels and tourism aren't in a great space. What data we saw come out on hotel revenues, the monthly data for March that came out in May, we still saw that hotel income was 28% down on the corresponding month of 2019. So the tourism sector is not yet anywhere near back to where it was prior to COVID-19. And I think that there's a few key issues here hampering it. For one, I don't think all the office or business-related travel is ever coming back. I think we've Zoomified a lot of our economic activity. So that part of the hotel sector, depending on office workers that are staying over on their travels, their business travels, I think a portion of that's not coming back. I think what high petrol prices do as well, they increase the cost of air travel too, I would think, quite significantly. So that can dampen both global tourism and domestic tourism of the holiday type and the business type. So I think that petrol prices, high fuel prices, can have a direct impact on the amount of tourism and therefore the amount of hotel stays. So I still think hotel property remains underperforming the three big commercial property sectors, those being retail, office and industrial. I think the impact on retail comes more indirectly, a reprioritization of expenditures by many consumers. They still have to travel, a lot of them, for commuting purposes where they can't avoid being in the office or at their place of work. And so I think there's a lot of reprioritization that happens. Luxury goods fall out of the bus to a certain extent, and non-essential items and postponable items such as clothing and footwear. And I think that those non-essentials and postponables being postponed and being deprioritized put more pressure on the bigger regional shopping centers and less on the smaller centers, neighborhood and convenience centers, which are more focused on essentials such as food and grocery shopping. I think that spend carries on more unhindered by this reprioritization by consumers. So I think it's a more of an impact on the bigger centres in retail. In the office sector, office has serious issues with a greater level of work from home post the pandemic, post the lockdowns, compared to what it was prior to the lockdowns. That our broker surveys tell us has led to a lot of companies being in the process of replanning their office space needs, and in many cases, I believe they will be downscaling. Now, this additional source of popularity for work from home potentially, I think many commuters, where they can, will possibly avoid going to the office as much now because of petrol prices too. So that leaves a lot of head offices and big office space around being underutilized, seriously underutilized. And I think that can just influence a few more companies to possibly replan and downscale on their office space needs. So the office sector, I think, can be potentially impacted by this. As for industrial property, not too much direct impact, I don't believe, from petrol price increases. Industrial property at the moment is in the relative pound seats. It can, of course, should global oil prices dampen the world economy and dampen our exports, dampen our trade in general, industrial property can start to see a negative impact. But at the moment, if we look at the manufacturing PMI for South Africa, it's still above 50, so it still signals expansion. So that's not really, the slowing economy hasn't really come into play yet for industrial property and the need for industrial space. So whereas all vacancy rates, according to our brokers, retail, office and industrial, were all declining up until recently, possibly that could stall in the retail space in the near term and in the office space, but I think a declining vacancy trend for industrial property is still on the cards. On the residential side, residential development in the first quarter, 14.5% year-on-year growth still in plans passed, so still growing, but it had been slowing, 17% in the previous quarter, and the prior quarter was higher than that. So there was a slowing trend, and I believe with rising interest rates, that keeps residential plans passed growth slowing and eventually into decline possibly later in the year. But the residential rental market, I think, benefits, relatively speaking, from interest rate hiking. I think a certain amount of aspirant buyers postpone their purchase, stay in the rental market, sustain better demand. And what we have been seeing in recent times is declining rental vacancy rates nationally, accelerating rental property growth, rental inflation, should I say. And I think although it's low, I think that acceleration in rental inflation is sustained in the near term, with vacancy rates coming down further. Tenants in good standing up above 80% of total tenants now. That's a relatively good number. So I think that the residential market is the one property market which is in a relatively good space in the near term as a result of interest rate hiking. Thank you.